side to side, but he's still struggling to wag his tail up and down. So we'll be starting first with the Families First Coronavirus Act so that we can give you a brief overview of that. That's the act that first came out first, and it is a tax credit act. So next slide, please, Liz. The Families First Coronavirus Response Act is an act that gives tax credits for the expanded Family and Medical Leave Act and for the Emergency Sick Leave Act. These are tax credits to the employer against Social Security taxes, which is 6.2%. It does not include the Medicare portion of Social Security tax. And so the employer will be taking these payroll credits against these amounts that an employer might pay for these benefits. Self-employed individuals can also receive these tax credits. Next slide, Liz. Oh, by the way, there is a chat button at the bottom of the screen. So if you have questions, you can leave them there. We will have a question and answer period afterwards for about 10 to 15 minutes, and we'll try to answer any of the questions that you have if we can answer them. So eligible employees for the Families First, the FFCRA, in general, they would be employees of a private sector employer that has fewer than 500 employees, all the way down to 1 employee, and certain public sector employees. And these employees are eligible for up to 80 hours of fully or partially paid sick leave for COVID-19 reasons, as shown below. These employees for the family leave, the Expanded Family Leave Act, who have been employed for at least 30 days prior to their leave request, may be eligible for up to an additional 10 weeks of partially paid expanded family and medical leave for reason number 5 below, which is caring for your child whose school or place of care is unavailable. And qualifying reasons for the leave are shown below, number 1 being subject to a federal, state, or local quarantine or isolation order related to COVID-19. Now, this is a federal, state, or local quarantine. This is not because you decided to self-quarantine or put yourself in isolation. Please, Betsy, can you please mute your computer? Betsy, please mute yourself. Thank you. And also that the employee has been advised by a healthcare provider. At bottom left-hand corner, Betsy, there should be a microphone. Just hit that. An employee has been advised by a healthcare provider to self-quarantine related to COVID-19, is experiencing COVID-19 symptoms and is seeking a medical diagnosis, and is caring for an individual subject to an order described in number 1 or 2 above. Number 5 is caring for the child whose school is closed or daycare is unavailable. And 6 is experiencing any other substantially similar condition specified by the U.S. Department of Health and Human Services. This number 6 is rather a wide definition of number 6. And we don't really have definitions of this, and it will have to be approved by the U.S. Department of Health and Human Services. Next slide, please. I'm sorry, there's a delay here. So the Families First, we just went through this. The Families First Coronavirus Response Act requires certain employees to provide their employees with this paid sick leave. This act goes into effect tomorrow. It's not an April Fool's joke. So generally, employers covered under the act must provide this to employees up to 2 weeks, 80 hours, or a part-time employee's 2-week equivalent. And this time can also be taken on an intermittent basis. So it does not have to be taken all at once. And so it would be paid at the higher of the regular rate of pay or the applicable state or federal minimum wage, and paid at 100% for reasons 1 through 3 in the box above, up to $511 per day, and in an aggregate of 5,110. So that's 10 days, 80 hours, 8 hours a day times 10 days for a total of 5,110. And then for reason numbers 4 and 6, it's up to $200 a day and 2,000 total. And for the employee who can take the Expanded Family and Medical Leave Act and has been employed with you for at least 30 days, they can use this Emergency Sick Leave Act first during the first 2 weeks, and then they're eligible for another 10 weeks of leave under the Expanded Family and Medical Leave Act, all paid at 2/3 of their pay, up to $200 per day, for a maximum pay of $12,000. Now, all this money that is being paid to these employees are set against your Social Security taxes. A part-time employee is eligible for leave for the number of hours the employee is normally scheduled to work over that period. Next slide, Liz. So actually, can you go back to that other slide, please, Liz? Back the other way. Oh, wrong way. There we go. So I want to go back to that because if you pay out, you're going to pay out this, and these, actually our system is going to be able to accommodate and track this for you. So it's not like something you're going to have to sit on your end and figure out for each employee. We're already working behind the scenes to get this all set up in our payroll system so that we can track this and cap these amounts and cap the totals for you. Okay, next slide. So the final thing is the CARES Act, which went into effect on Friday. So the effective date of the CARES Act is March 27th, which offers a 5th tax credit and tax deferral. So I'm sure you all want to hear about the SBA loan amounts. So there are 2 different portions of the CARES Act. The first one being this tax deferral. So we're going to call this the tax deferral portion, and then we'll go into the loan portion. So under the tax deferral portion, the first portion of this act, there's a payroll tax credit for employee retention, and there's a deferral of the Social Security taxes under a deferral of the employer share of the Social Security taxes. Oh, let me back up one more second because there's something important I forgot to mention. If you if you had to pay out to these employees more than the taxes that are owed under these set aside taxes for Social Security from the payroll, we would keep track of that for you, and you would be able to apply for the overage that would be in a separate check that would be mailed to you as to this overage. Also, so back to this slide, self-employed individuals also can receive a deferral of these taxes. Next slide, please, Liz. So employers may defer an employer share of the Social Security tax due for the period beginning on the date of the enactment, which was March 27th through December 31st. The deferral option is not available if the taxpayer has had indebtedness forgiven under the new SBA loan forgiveness provisions, which we'll go into next. So you are either going to choose this program or the SBA loan program with the forgiveness portion. And in addition, there are some other options to employers. So next slide, please. The employer tax credit for the employee retention related to COVID-19 is a credit available to any employer that was carrying on business during calendar year 2020 and with respect to any calendar quarter wherein its operations fully or partially suspended under government orders due to COVID-19, or the operation had a decline of at least 50% in gross receipts as compared to the same calendar quarter in the prior year. The amount of this tax credit is 50% of qualified wages with respect to each employee for the quarter. The maximum wages taken into account per employee is $10,000 per employee, so the maximum credit is $5,000 per employee. The qualified wages mean that employers with greater than 100 full-time employees are wages paid to employees not performing services due to COVID-19 related circumstances, which would be either a suspension of operations or a reduction in gross receipts, or employers with less than 100 full-time employees, which is most of you here. Now, all employee wages paid are eligible, and this includes employers' properly allocable qualified health plan expenses, and it excludes wages taken into account under the paid sick family leave, which we just spoke briefly about, the FFCRA, and because you're receiving 100% credit for those wages. Next slide, please. So this credit is taken against the employer portion of Social Security taxes, and the excess credit is treated as an overpayment that shall be refunded. So it's for this section. I'm sorry, it didn't apply to the other section, but it applies here. And the credit applies to the customer, not the PEO. So your relationship with Clear PEO does not adversely affect your ability to get any of these loans or use any of these benefits that are available to you here. And tax-exempt employers are treated as eligible employers for purposes of the credit, and there cannot be any double dipping with regard to work opportunity credits or employer credits for paid family and medical leave under the FFCRA. So these tax credit in this first section of the CARES Act are not available if eligible employers receive a covered loan under SBA's new Paycheck Protection Program. So the Treasury and IRS authority includes guidance to third-party payers, including PEOs, allowing us as PEOs to submit documentation necessary to substantiate the eligible employer status of employers that use PEOs. So as I said, you're not penalized at all for being part of a PEO. Next slide, please. Other CARES Act provisions. So you might have a lot of questions about this state unemployment expansion. So I just got some more information about this just a few minutes ago. So say like in Florida, that I know that the maximum amount of unemployment in Florida is $275 a week. These employees who are eligible for unemployment under COVID-19 reasons, and there's a list of about 10 of them, would be eligible for $600 extra per week, regardless of how much they make. And this is per week, and it lasts for 4 months up until July 31st. But the actual entire unemployment will be extended for 39 weeks under this new act. In addition, the paid leave is available to rehired employees. So if you're bringing an employee back, the act is available until December 31st, and a school closes again, and those people need to go out, or because the school closes again, then they would be eligible for this paid leave. Also, please note that if you do have employees out already on FMLA leave, the amount of leave that they have already taken will apply to the 12 weeks that they are eligible for in a 1-year period. Also, there is the health savings account and the telemedicine. As you know, health savings account or some high deductible health plans, the deductible will not apply for any COVID related medical expenses, and telemedicine has decided to not impose a copay for any visits on telemedicine. And over-the-counter items that are typically not covered under an HSA will now be covered. There's listings out on the web about which items they are. And there's also retirement plan relief, which increases loan caps and waivers the 2020 the required minimum distributions and education loans, etc. So next slide, please, Liz. Sorry about that. So the SBA Paycheck Protection Program. So this is called the PPP, which is everyone is looking for right now. And under the PPP, I know that a lot of you want this information right away. And so we got some documentation today that the Treasury Department and the Small Business Administration, the SBA, are working this week on promulgating regulations that will guide this program. They are expected to be done by Thursday, likely late in the day. The Treasury Secretary said yesterday that these loans will be available starting on Friday, which will be at lightning speed. To be clear, no one is applying for PPP loans right now because it is not possible. I just went to that website and there's information on the SBA website regarding those loans, but there is not the application to apply for those loans. So there is information, and so some application is being sent around, and it is for the economic injury disaster loans, the EIDL, the EIDL. That application is out there and employers can apply for that. But it is quite different than the Paycheck Protection Program because it does not have a loan forgiveness component. So to be clear, no one is applying for PPP loans right now because it is not possible. The program does not yet exist operationally. There are no forms yet on the SBA site. Some confusion may lie in the fact that there are these economic injury disaster loans from the SBA that have been around for years. However, they are different, as I said, because they do not have the loan forgiveness. So the Paycheck Protection Program establishes $350 billion for the provision of loans to small businesses. It's a new type of SBA Section 7A loan. For loans made, for loans made between February 20th and June 30th, and it's only available to qualifying small employers, and a certain amount of the loan amounts are eligible for forgiveness. And again, these loans are at the client level, and PEO affiliation with CLEAR is disregarded. Next slide, please. So the Paycheck Protection Loan, so a PPL is part of the Paycheck Protection Program. So a Paycheck Protection Loan is available during the covered period, which begins February 15th and ends June 30th. These loans can be made directly by the US SBA or by lenders who are already authorized to make loans under the SBA's current business loan program. Other private sector lenders may be authorized by United States Treasury. The following terms would apply for each loan. The interest rate cannot exceed 4% or a maximum maturity of 10 years. There will be no collateral or personal guarantee required, and there's no prepayment penalty. Payments of principal, interest, and fees would be deferred for not less than 6 months and not more than 1 year. Loan recipients that maintain their payrolls are eligible to have the portion of the loans used for qualifying payroll costs, interest on mortgage obligations, rent, and utilities forgiven. Next slide, please. To qualify for the Paycheck Protection Loan, an eligible business must make a good faith certification that the loan is necessary to support ongoing operation of the business as a result of the uncertainty of current economic conditions. Funds will be used to retain workers and maintain payroll or make mortgage payments, lease payments, and utility payments. The business does not have an application pending or a loan under the business loan program for the same purpose, and the business has not and will not receive other funds under the business loan program between February 15th and December 31st. Next slide, Liz. So PPP loans, Payroll Protection Program loans, or PPL loans. Next slide, please. This is the second part of the CARES Act. The first act, the first part was the tax deferral act, or the tax deferral portion of the CARES Act. And then this is the PPP is the second part of the CARES Act. So are you eligible? You're eligible if you have fewer than 500 employees, you're a small business that otherwise meets the SBA size standard, you're a 501c3 with fewer than 500, an individual who operates as a sole proprietor, an individual who operates as an independent contractor, an individual who is self-employed, who regularly carries on any trade or business, a tribal business concern, a 501c19 veterans organization that meets the SBA size standard. In addition, some special rules may make you eligible. If you are in the accommodation and food services sector, the 500 employee rule is applied on a per physical location. If you are operating as a franchise or receive financial assistance from an approved small business investment company, the normal affiliation rules do not apply. Remember, the 500 employee threshold includes all employees, full-time, part-time, and any other status. Next slide, please. What is a small business concern? It's a for-profit organization that is independently owned and has a place of business in the United States and operates primarily in the US or makes a significant contribution to the US economy. It is not dominant in its field of operations. It meets certain size standards. The SBA has the authority to determine exactly what size constraints apply on an industry by industry basis based on NAICS codes, and affiliation rules do apply. So we'll talk about next slide, please. This is what affiliation rules are. The general principles of affiliation exist when one business controls or has the power to control another, or when a third party or parties controls or has the power to control both businesses. Control may arise through ownership, management, or other relationships or interactions between the parties. SBA's regulations on affiliation are contained at the SBA website shown here, and additional guidance at the SBA website. As I mentioned at the beginning of the webinar, that this is being recorded and it will be out on the Clear Employer website so that you can take advantage of going back and reviewing all of the slides and the content and my words. Next slide, please. So the loan characteristics of the PPP are the following. The maximum loan amount is lesser of a 250% of average monthly payroll, which is 2.5 times the payroll amount. So if you have a $10,000 payroll, that would be $25,000. And it's based on a 12-month look back or the maximum of 10 million. The loans will be 100% guaranteed by the SBA. The availability of credit from other sources does not disqualify eligibility. So you can take the credit from the FFCRA, the taxes against Social Security, and also get this loan. However, you won't be able to take the credit for those amounts that you were refunded for from Social Security tax, but you can still apply for this loan. There are no application fees allowed, no closing costs. There's no recourse, no collateral or personal guarantees, and allowed to be imposed. The maximum interest rate is 4%, and maximum loan term of 10 years is the maximum. And the first 6 months are automatically deferred, and deferral can last up to a year. Next slide, please. So how you calculate this is the average total monthly payments of payroll costs, which we'll go over what payroll costs are on the next slide, during the 1-year period before the date the loan is made, and there's a special rule for seasonal employers. So the average total monthly payments of payroll costs times 2.5 equals the maximum loan amount, and it's capped at 10 million. Next slide, please. So the payroll costs are defined here, and this is at a pretty high level because this gets rather complicated, but you can get a general idea. So it's for the salary, wages, and commissions of similar compensation, and it's capped at $100,000 per employee. It includes cash tips or equivalents, payments for vacation, parental, family, medical, or sick leave. There's allowance for dismissal or separation, group healthcare benefits, including insurance and premiums that the employer pay. Generally, this applies to premiums that you're paying when someone is out on the expanded Family and Medical Leave Act or during the Emergency Sick Leave Act. There's a retirement benefits are part of the definition of payroll costs, state or local tax assessed on the compensation of employees, and certain sole proprietor and independent contractor compensation. Next slide, please. So permitted uses for the loan proceeds. So during the 8-week period that begins on the date of your PPP loan, the proceeds can be used for payroll costs, which includes everything that we just spoke about, in addition to costs related to continuation of group healthcare benefits during periods of paid sick, medical, or family leave, and insurance premiums. From what I understand, these insurance premiums include health, dental, and vision. We still don't have guidance on whether they may include long-term disability or life insurance premiums that you're paying on behalf of employees. And we'll have to give you answers on that when we find out ourselves. It does include employees' salaries, commissions, or similar compensations, and payments of interest on any mortgage obligation, but not prepayments, rent or lease costs, utility charges, interest on other debt obligations assumed prior to February 15th, and any other purpose permissible under the SBA Act's business loan program, which you would have to speak with your accountant about. Next slide, please. So the loan forgiveness. So there's a detailed calculation for how you calculate the loan forgiveness amount. Next slide, please. So the loan forgiveness generally, and this is at a very high level that we're giving you this information, the loan forgiveness allows for some portion of the covered loan payments to be forgiven. Generally, these forgiven amounts are limited to payment of qualifying expenses, and the forgiven amounts are not taxable to the small business. Next slide. So these are the types of loan forgiveness amounts, and it's shown here in this graphic. So it includes payroll costs, as we described earlier. It includes covered mortgage obligations, which are generally debt incurred on real or personal property before February 15th. It includes covered utility payments for utilities for services which began before February 15th, and rent obligations, which is equal to rent obligated under a lease in effect before February 15th. Next slide, please. So the forgiveness amount is reduced for the following reasons, and we have an example of how this will work on a subsequent slide, so bear with us. The forgiveness amount is reduced by reducing the number of employees, number one, and then number two, reducing salaries and wages. So the maximum eligible forgiveness amount is multiplied by the average number of full-time equivalent employees. And this is similar, and maybe Melanie, who is in benefits, will be able to assist us with this as you go through this process, because it's similar to how the Affordable Care Act is calculated. It's the average number of full-time equivalent employees per month during the covered period, which is that 8-week period during the forgiveness, or during the loan period, from the time that you get the loan and then 8 weeks later, divided by the average number of full-time equivalent employees per month during the choice period. And the choice period is a period that is determined by your lender. And then we also subtract out the amount of the loan forgiveness that has been also affected by any reduction in total salary or wages of an employee. Next slide, please. So this is the part that is the reduction of employees. So it's going to look at your head count like before, and then your head count, the average number of full-time employees during the covered period that when you first get this loan. So if your loan started on April 1st, it's going to look at the average number of employees, like from April 1st to 8 weeks later. What is that? May 30th or whatever. And then divided that by the number of full-time employees that will be the choice period, which may be either February 15th to June 30th or January 1st to February 29th. So the maximum eligible forgiveness amount is multiplied by that number. Next slide, please. On top of that, then they would subtract how much have you reduced salaries. And so there's a calculation for that. It's during the covered period that is in excess of 25% of the total salary or wages of the employee during the most recent full quarter during which the employee was employed before the covered period. We've already talked about what the covered period, and actually, I'm sorry, the covered period, and when I'm using these terms, these are terms that we actually used in order to present this to you. They're not actually terms that the SBA may use or your accountant may use. Next slide, please. So here's how it all works. So in this example, Joe's Hardware has 300,000 of eligible forgiveness amounts. So he has 230,000 of payroll costs. He has 50,000 of rent, 10,000 of utility costs, and 10,000 of interest obligations. Therefore, add that all up, it comes to 300,000 of the maximum eligible forgiveness amount. Then we take and multiply that Joe had in this 8-week period beginning on April 1st. He had 25 full-time equivalent employees during that 8-week period. He then divides that number by 30, which is the average number of full-time equivalent employees he had during his choice period. And that's our word also that we're using for this, but your accountant or the SBA may use something else. This results in a quotient of 0.833. Then Joe multiplies this 0.833 by 300,000 for a product of 250,000. Therefore, his maximum eligible forgiveness for this loan is 50,000. So right now, he has a loan that's forgivable of 250,000, and 50,000 he would be responsible for paying. But we now have to subtract the fact that Joe also took Susie's salary and reduced it from 40,000 to 20,000 during the cover period. And therefore, if you take 25% of the 40,000, it's his maximum eligible forgiveness amount has been reduced by another 10,000. So he now owes 60,000, but he has a loan of 300,000, and so he has 240,000 that is forgivable. Next slide, please. So to apply for this Paycheck Protection loan, the borrowers must provide documentation verifying employees on payroll and their pay rates. I know that some of you have already been asking for these reports, and I believe that Sarah is working on something because of the volume of the request. She is trying to put something together so that you can go into your system and run these reports on your own. And I'm not sure when we'll get that out, but as soon as we can, perhaps this may be something that you might be able to do on your own. And secondly, documentation on covered costs and payments, obviously verifying your mortgage, rent, and utility payments, and certification from an authorized representative of the borrower that the documentation is true and correct, and that forgiveness amounts requested were used to retain these employees and make other forgiveness eligible payments, and any other documentation that may be required. Now, this is a really important fact on the bottom. Forgiveness reductions. So when we just saw that you had a $300,000 loan that was reduced to $240,000 because you reduced headcount and you cut pay. These reductions won't apply with respect to the employee's discharge between February 15th and 30 days after the enactment of the CARES Act, which is up to, the CARES Act went into effect on March 27th, up to April 27th, or whatever 30 days is from March 27th, or wage reductions during that time period, if no later than June 30th, you, the employer, replace that employee or make up for the wage reductions as applicable. So important. So you aren't penalized for that amount that we just talked about, where Joe had his head count dropped and he had to make that adjustment on his forgiveness amount. You won't be penalized if you've done that, if you rehire these employees no later than June 30th. And honestly, I just heard something, and I don't have all the details on it, but I don't think that you have to hire the same person back. So if that person doesn't want to come back, I believe you can replace them with a different employee. Next slide, please. So this is sort of a chart that there's so many options to you right now. Actually, just before the webinar, I was given some charts, and we didn't have time to put them into the presentation, that would show you how all of these coordinate together. We are going to drop them into these slides that you can see. If you do this, you won't be able to do this. So as I told you earlier, if you take the tax credit under the first part of the CARES Act, you cannot take the PPP, but you can take the tax credit from the Families First Corona Response Act and take the PPP. You just won't be able to use those wages as part of the forgiveness in the PPP. So this is a slide that you'll be able to look at on your own and see which way may be the best way for you to go. In addition, you also have those EIDL loans out there that are the economic disaster relief, but remember that they do not have the forgiveness portion attached to them. Next slide, please. So what will the lenders be looking for? In determining eligibility, the lenders are directed to consider whether the borrower was in operation before February 15 and had employees for whom they paid salaries and payroll taxes, or paid independent contractors. 1099 employees do count here. So lenders will ask you for a good faith certification that the uncertainty of current economic conditions makes the loan request necessary to support ongoing operations. The borrower will use the loan proceeds to retain workers and maintain payroll or make mortgage, lease, and utility payments. The borrower does not have an application pending for a loan duplicative of the purpose and amounts applied for here. And from February 15th to December 31st, the borrower has not received a loan duplicative of the purpose and amounts applied for here. However, there's an opportunity to fold these emergency loans made between January 31 and the date this loan program becomes available into an entirely new loan. If you are an independent contractor, sole proprietor, or self-employed individual, lenders will also be looking for certain documents, and we don't have all the details on that, such as payroll tax filings, forms 1099, miscellaneous, and income expenses from the sole proprietorship. Next slide, please. What lenders will not look for is that the borrower sought and was unable to obtain credit elsewhere, that a personal guarantee is not required for the loan, and that no collateral is required for the loan. Next slide, please. So we are so happy that you joined us today. This is at a very high level, and we are not providing legal advice. However, we are here for you, and I'm here for you, and Liz is here for you to answer any of your HR related questions. Again, this will be out on the website, and we will answer the questions as soon as we can. We do have the chat, and Liz is going to open that up now to see if we can answer any of the questions. You're welcome to remain and listen. Thank you for attending. I wish I was giving you a yoga class instead of this. Liz? Liz? Let me see if I can open up the chat and see the questions. So the slides will be out on the website. Okay. So you can access them there at clearemployerservices.com. Yes, employees can split their, are you talking, Betsy, are you talking about the emergency sick leave? I would imagine you are, or the family leave, and yes, you can split it. It can be taken on an intermittent basis. We don't have any details on, well, I included some information on what will be needed for the loan, but we don't have real specific details. You're going to have to apply for this. I believe the application will be out on the SBA website, or you can also go to an independent lender that is affiliated with the SBA. There are special rules for seasonal businesses, and we will help you with that, or you can also look at the information on the SBA website in regards to that. And yes, 1099 employees are included in the payroll calculations and as employees. Is business insurance included? I'm not sure, so I've not seen that detail yet. You'd have to get that from your accountant. Are payroll processing fees included? Very good question. We don't have guidance on that yet, so we will need to get back to you about that. If you reduce your hours but still keep the employees working toward this time, are you still eligible to apply for PPP? Oh yes, you can apply. Your forgiveness amount will be less. You absolutely can still apply. Your forgiveness amount will be reduced by the amount of pay that you will be reducing because of the reduction in hours. Also, I just want to point out that if you are thinking about reducing pay, you have to be very careful in reducing hours and pay for employees who are paid on a salaried exempt basis. If you have any questions about that, please reach out to me before you make those decisions, because you could affect the Fair Labor Standards Act exemption for those employees. That's all we have right now. If you have any questions, please reach out to me or anyone on the CLEAR team, and we'd be happy to help you. Thanks so much for attending. Have a good afternoon, and please stay safe and healthy. Bye, everyone.